Last week, the stock market experienced losses for the first time in over a month after the Fed delivered a grim summary of economic projections. With so much change and uncertainty across industries, real estate has remained assuringly constant. In short, rates continue to sink and investors continue to swim. The 30-year fixed-rate mortgage has been hovering around the 3% mark for some time now, and rate volatility does not seem to be a threat. So how exactly is the stability achieved in times like these? Let's take a closer look at the role of the Fed and its hand in real estate. I'm Chris Cornish, and this is your Mortgage Market Watch. First, a teaching moment. What is the Fed anyways? The Fed, or the Federal Reserve System, is the U.S. central bank. Its purpose is to provide the country with a stable monetary and financial system, which it achieves in two specific ways: keeping unemployment low and keeping prices reasonable. Well, as we established last week, we're in a recession right now, which typically means that unemployment rises and prices fall, also known as deflation. Deflation in and of itself is not actually that harmful to the economy. It is, however, bad for the banks because it leads to debt deflation, which increases the real value of debt. And when the amount owed becomes greater than the price of the asset that secures it, the risk of default skyrockets. So to protect banks, the Fed often steps in to reinflate the economy. One tool it uses to do this is called open market operations. Basically, this means that the Fed buys up debt, securities, bonds, and other assets to flood the markets with available credit and encourage the banks to lend it out at a reduced rate. For struggling businesses and individuals, this would mean that rather than laying people off or defaulting on existing loans, they might be able to borrow more money to get back on their feet. This is what the initial $700 billion quantitative easing plan was since March. As of last week, they also promised to continue to buy another $80 billion in treasuries and $40 billion in mortgage-backed securities every month. Another tool that the Fed uses to prop up the economy is called discount lending. This is when the Fed directly lends money to banks through what they call the discount window. Traditionally, these loans have carried high interest rates and were used as a measure of last resort in order to shield taxpayers from risky bank ventures. But in recent years, the Fed has expanded this practice, dropping the rate to a record 0.25%. What's more, they rolled out other lending facilities, including the PPP, or Paycheck Protection Program, and as of late, a new Main Street lending facility designed to help businesses that are too big to qualify for the PPP. We've talked in the past about how the housing market has a supply shortage. Well, right now, supply is actually 18.9% lower than it was this time last year. This bodes particularly well for sellers. In fact, we've been seeing an increase in bidding wars in areas like Dallas, Denver, San Jose, Los Angeles, and more. With interest rates being kept down and the Fed continuing to ensure the availability of credit, we expect the housing, or at the very least the financial market, to remain stable for the foreseeable future. This has been your Mortgage Market Watch. For more insights, sign up for a weekly report and subscribe to our content. Till next week.